What if I told you a high-yield dividend ETF beat the S&P 500 index by 13% last year? Is that something you might be interested in? Well, that dividend ETF is SCHD, the Schwab US Dividend Equity ETF, and we'll take a closer look at that now. How's it going, everybody? Welcome back to the channel. My name is Jay, and on the menu for today, we have another dividend ETF. This one is the Charles Schwab US Dividend Equity ETF, and it's under ticker symbol SCHD. It's got a dividend yield that's double that of the S&P 500, and it has the growth to match. So is SCHD as good as it looks? We'll look at all the important details of SCHD, how SCHD stacks up against similar dividend ETFs and our general index ETFs, and whether or not SCHD is a dividend ETF that has a worthy place in your portfolio. But first, I have to stop and ask you to please hit the like button down below on this video. It's a simple gesture, but it pays big dividends for both this video and my channel in the eyes of the almighty YouTube algorithm. So with that out of the way, let's dig in. Let's look at SCHD, the Schwab US Dividend Equity ETF. And the first thing we got to look at is, how does the SCHD ETF choose the dividend stocks that it holds? The first level of the selection criteria for the SCHD ETF is the index that it tries to track. And the index used for SCHD is the Dow Jones US Broad Market Index. Now, an important thing about this index is there are no REITs included. And that's an important factor because generally REITs are big dividend payers, and there's something that you might find included a lot in a dividend ETF such as SCHD. Next, SCHD looks for 10 consecutive years of dividend payments. That means only consistent dividend payers, stocks that have shown over a relatively long period that they can keep and pay out a dividend, are going to meet the criteria for this ETF. Next up, the stocks included in SCHD have to have a minimum market cap of $500 million. That means we're generally talking about larger companies, large cap, established stock. And another important part of the SCHD criteria are that the stocks included have to have a minimum daily trading volume of 2 million shares per day over a 3-month period. This makes sure that any stock that gets included in the ETF has a good volume, and the ETF isn't going to get stuck being unable to buy or sell it when needed. Once SCHD goes through all of those steps, the stocks are then ranked in descending order by dividend yield, and only the top half are selected. But it's not like those top half get automatically thrown into the ETF. SCHD will then score each one of those stocks on the following criteria: the company's cash flow to the total debt, the return on equity, the indicated dividend yield, that means it factors in any announced dividend raises or cuts, and the 5-year dividend growth rate. SCHD will rank each stock according to each one of those factors, compare them all against each other, and then select the top 100 scoring stocks according to all that criteria I just listed. There's a pretty strict criteria on how stocks are added and maintained within the SCHD ETF as well. First off, stocks are weighted based on their market cap. So larger companies will have a larger weighting. No one stock can make up more than 4% of the ETF at any one time. That's an important factor because you don't want any one or two stocks weighing too heavily on the performance of the overall ETF. Then again, there are no REITs in the SCHD ETF, and along with making sure that no one stock makes up more than 4% of the ETF, they make sure that no one sector makes up more than 25% of the overall ETF. So by limiting how much an individual sector can make of the ETF, you limit the positive or negative influence that any one industry is going to have on your overall returns. Now, in the event any one stock or any one sector does become too heavily weighted and goes over those limits for an extended period of time, the SCHD ETF will rebalance to get things back in line. Otherwise, the ETF only rebalances its holdings on an annual basis, so there's not a ton of trading that's going to be going on in the SCHD ETF. When rebalancing time does come, the only way one of those 100 stocks is going to get knocked out of the ETF is if its ranking score, based on those factors we talked about earlier, knocks it out of the top 200 stocks that are being evaluated. So when SCHD does kick stocks out when it rebalances, the new stocks it brings in the highest ranking stocks first. Then they repeat that process until all 100 slots are filled, and that's the new holdings for the ETF in the next year. Naturally, the next question is, what are the top holdings of SCHD? Here you can see the top 10 holdings of SCHD SCHD as they currently sit. The top 10 stocks make up just over 40% of the total assets of the ETF. We got the Home Depot leading the way at 4.58%, followed by IBM at 4.18 and Pfizer at 4.17. Those are above the 4% threshold, and if they stay that way or if they grow to a higher percentage, yes, they will get rebalanced down. Following those, we have Pepsi, Texas Instruments, Cisco Systems, Coca-Cola, Amgen, Broadcom, and BlackRock. So you're probably familiar with most, if not all of those names. They're solid companies that have been around a long time and have good histories as solid dividend payers. When you're evaluating dividend ETFs like this, it's important to take a look at the top holdings. Because these aren't following just a general index like, say, the S&P 500, with a dividend ETF, each one is going to be vastly different, so you really want to look into them, see what they hold, see how they choose their stocks, and see how they perform. And that ever so smoothly leads us into how does SCHD perform? And we'll start by comparing SCHD's performance to one of the other most popular dividend ETFs on the market today. It's one I also did an entire video on in the past, and that's VYM, which is the Vanguard High Dividend Yield ETF. When we look at SCHD versus VYM, you can see over the past year, SCHD has outperformed VYM with dividends included by 13%. If we take a step back and we compare SCHD versus VYM for the entire history of SCHD's existence, SCHD outperforms VYM over the past 10 years by 68%, dividends included. That's a huge difference in overall returns between two things that on the surface look like they both have the same goal. Both these generally yield the same amount when it comes to the dividends. SCHD vastly outperforms when it comes to the added growth on top of that. Next, let's look at how SCHD performs compared to a broad market index fund. This is generally where the flaws in these dividend ETFs come out. When we took a look at VYM back in that video, we saw VYM severely lagged the overall performance of VTI, even when taking in consideration the higher dividend yield that VYM has. So let's look at SCHD versus VTI. If we look at the past year's performance, SCHD actually outperforms VTI by 9.5%. Over the history of the ETF, it only lags VTI by 4%. Over the history of the ETF, it's essentially even with the total broad market index that VTI is. And yes, like I mentioned in the intro, the numbers I teased you with, if we compare SCHD versus VOO, which is the S&P 500 index ETF, over the past year, SCHD outperforms by 13.4%. Over a 3-year period, it's outperforming the S&P 500 by over 10%. And just like we saw with VTI, since the inception of the fund, it only lags the S&P 500 index very slightly at about 5%. This is an extremely impressive performance from a dividend ETF. Not only that it only lags the broad market index funds by a few minuscule percent over a 10-year period, but that it's outperforming over both 1 and 3-year periods. If you think about what's been going on in the markets over the past 3 to 5 years, the massive gains, the massive returns in the markets have been driven by these high growth tech stocks that don't pay dividends. They're not going to be included in something like SCHD, but they are included in VTI. They are included in VOO, the S&P 500. For all this growth in the overall market to be dominated by those high growth tech stocks, yet this dividend ETF to be outperforming them is nothing short of extraordinary in my opinion. Okay, so what's the catch? This thing has extremely high fees, right? Sure, the performance looks great, the dividends are great, but we gotta pay for it, right? Actually, not so much. SCHD has an expense ratio of 0.06%. Yes, that is higher than our typical Vanguard index funds we love. VTI, VOO are both at 0.03%, but it's right in line with Vanguard's dividend index, VYM, which is also 0.06%. Some other quick notes to look at are SCHD historically has a dividend yield between 2.7 and 3%. This is right around 2.5 times what you're gonna get out of something like VOO or VTI. So it's got a dividend yield well above the general market. Also, the dividends per share for the ETF have grown every year of its existence. Back in 2012, SCHD was paying 81 cents per share in the dividend, whereas last year in 2020, that had risen to $2.03 per share. Not only you're getting a good yield, you're getting good performance, but you can also count on steady dividend growth as well. If you're still with me, please hit the like button down below if you haven't already. Like I said, it really helps out. Subscribe to the channel if you want to see more videos like this. The pros of the SCHD ETF, in my opinion, are it's got a good balance of yield and high quality stocks. It's not an ETF that's chasing high dividend yields in crappy stocks. If we looked into this thing and saw, oh, 10% of the ETF is made up of AT&T, which is a stock that a lot of people loved for its really high dividend yield, but as we usually see with those kind of stocks, its dividend is getting cut by 40 or 50%. SCHD really doesn't go chasing that kind of thing, and that is a good sign. Another pro, as we just talked about in depth, it's got really impressive growth for a dividend ETF. So you're not sacrificing overall returns just in the name of income. Another pro, it's got a low expense ratio, 0.06%. Again, basically nothing. Very low cost ETF, which we always love to see. And I'm a big fan that no one stock makes up more than 4% of the overall portfolio. It does its job to keep it well diversified, doesn't let any one company have too much of an effect on the overall ETF. A couple cons to the SCHD ETF that you may want to consider are only 100 stocks are included in the ETF. That means it's definitely not as well diversified as an index fund like the S&P 500 index, which will have 500 stocks, VTI, which has over 3,000 stocks, or even its competitor VYM, which holds over 400 stocks. It's a little more concentrated than those, even though it does its job to diversify within those 100 stocks. And another con, another thing we might want to take pause at, is that the SCHD ETF has only been around since 2011. So we've only got 10 years of history, and those 10 years of history are in one of the best roaring bull markets we have ever seen. We don't know how the ETF will perform if we get an extended recession. We don't know if it'll be able to keep up its performance and its dividend payouts like that. I have no reason to believe it won't perform all right in a recession just based on how stringently they pick stocks, but we haven't seen it yet because we only have those 10 years of history. All things considered though, I think SCHD is probably one of the best dividend ETFs on the market today. Full disclosure, I have added SCHD to my passive ETF portfolio. That doesn't mean it's right for you and your investing criteria. You got to make those decisions for yourself. But in the name of transparency, I should say, yes, I do own it. I did buy some. If you want to see my other videos on the other dividend ETFs we've looked at so far, you can check those out right over here. Subscribe to the channel if you haven't already. I really thank you for watching. I hope you enjoyed this, and I will see you in the next video.